how do you actually invest your money and build your wealth. And there's two ways that you can get paid as an investor. You can watch the value of investment go up, called growth, or you can get paid with cash flow. Cash flow is money being deposited into your bank account every month, every 3 months, or every year, because you own the right investments. And you have to find what's right for you. There are pros with growth. The pros with growth are, if you see growth in your investments, you don't pay taxes until you sell. But the risk with that is, well, if you invest your money into a stock and it goes up to $200 a share, you don't actually make money until you sell. So if you decide to sell it the next day and the value falls to $100, well, now you lost that growth that you had. When it comes to cash flow, pros and cons here. The pro is you get that money in your pocket today, but the con is that you have to pay taxes on that money, because as soon as you get the money deposited into your account, it's a taxable income. Con number two is if an investment is giving their money away, that investment can't grow as fast. Because let's just say hypothetically you invested your money into the McDonald's stock. Well, McDonald's makes billions of dollars a year in profits. There's three things they can do with that profit. They can save that money for an emergency. They can reinvest that money back into the company by opening new stores, making better burgers, or they can give that money away in the form of cash flow. It's called a dividend in the stock market, which is something that they're doing at the time we're recording this video. But if they're giving their money away, that's money that they're not using to make better burgers or open more stores. So if a company is giving away cash flow, then they can't grow as fast. So you have to decide what's right for you. For me, personally, my first goal, and something that I still like, is cash flow, because I like the idea of not having to sell my investments. I like the idea of stacking the cash flow slowly and then working to just grow the value of the cash flow year after year after year. That way I can just keep accumulating more assets and then live off the cash flow. But it takes a lot of time, it takes a lot of work, it takes a lot of sacrifice, and the first few years of doing this type of cash flow investing is extremely painful, because you're going to be working really hard and putting a lot of money in and getting no cash flow out. But if you do this for 5 years, 10 years, 15 years, you'll start to see a steady stream of brand new income from your cash flow. But you have to be willing to put in the work for years to be able to see those types of returns, and a lot of people just don't have that in them. Once you understand your goal and how you want to get paid as an investor, now we can actually talk about how do you invest your money with steps 5 and 6. So let me start with step number 5, investing your money with a proper retirement account. The most common government-sponsored retirement accounts are 401ks and IRAs, and there are other variations of 401ks like 403bs, which are for different professions, but they're all essentially the same thing. So with a 401k, what this is it is an employer-sponsored account where your company will allow you to invest your money into an account, and then the money can grow tax-free until you pull the money out. An IRA is a way that you can do essentially the same thing, but you're going to do it outside of your company. But the thing you should be aware of is that 401ks and IRAs have limitations on where you can invest your money and when you can pull your money out. The general rule with a 401k or IRA is you have to let your money sit there until you were at least 59 and a half years old. Otherwise, you are going to be subject to a 10% penalty. And when it comes to where you invest your money, these rules might be changing because President Trump recently signed an executive order as to where you can invest your money in a 401k. But generally, the way it works is you're going to have to invest your money into funds, mutual funds, sometimes index funds, through a 401k or IRA, which are giving you exposure to the stock market, which is great, but you do generally just have some limitations. And you should also understand the difference between a traditional versus a Roth 401k and an IRA, because they work the same way. A traditional account is you make money, you don't pay taxes, and then it goes directly into your 401k or IRA. So let's assume that you want to invest $2,000. This $2,000 would go tax-free into your 401k or IRA. It would then grow in this 401k or IRA until you're 65, 67, 70 years old, however old you want to be. And then you pull the money out, and that's when you're going to pay taxes. So let's assume that your $2,000 grew to $20,000. When you pull that $20,000 out, now you're going to pay taxes. And the amount of taxes you're going to pay are going to depend on what your income is going to be when you're older, and number two, what the tax rates are. We don't know what tax rates are going to be in 10 years, let alone 40 years. So there's a big question mark as to what this tax is going to be. And if you plan on having no income when you're older, well, that could mean that you're going to be in a lower tax bracket, but we don't know what the tax rate is going to be. I don't like that idea because I want to grow my income every single year, and I don't like the idea of having no income because I'm an entrepreneur, I'm an investor. I want to see my income grow in the future. And so this is where Roths can also come in play. The way a Roth works is you're going to make money, then you're going to pay taxes first. after you pay taxes, that's the money that's going to go into this account. It's going to be less than here because this is after tax dollars. So maybe this is only $1,500. And now the money is going to grow and compound in this account. And then when it comes time for you to retire, you can pull this money out. Maybe now this is going to be $15,000, which, yes, is less than the $20,000, but you don't have to worry about taxes when you pull the money out because you paid taxes in the beginning. Now, the last thing that I want to say about these government-sponsored retirement accounts like a 401k or IRA is that they work for the right person. For me personally, I don't like 401ks and IRAs because they don't fit my personal investing portfolio, and I know that I can get better tax breaks outside of a 401k and IRA through different investment vehicles, which are also out there, which I'm going to discuss next. But this is where you want to understand what the options are. This is a great place to start. It's very accessible, and if you like it, keep it. If you don't like it, well, you can also see what the other investment options are. So this brings me to number 6, your own private investment options. There are many ways to invest your money. Some people will tell you that you have to invest in stocks to become wealthy. Other people will tell you have to invest in real estate to become wealthy. Other people will tell you you have to start a business to become wealthy. The reality is it doesn't really matter. You just have to find what's right for you. I mean, Warren Buffett became extremely wealthy in the stock market. Donald Trump became extremely wealthy in the real estate market. And you have a lot of entrepreneurs that have built businesses and become extremely wealthy without ever touching stocks or real estate. So let's talk about some of the different investment options that you have. You can invest your money in stocks. You can invest your money in real estate. You can invest your money in crypto. You can invest your money into commodities like physical gold. You can invest your money into buying a business. You can invest your money by lending it out and generating interest. Or you can invest your money in startups. Now, the two asset classes that have been proven through the test of time are stocks and real estate. Now, yes, gold is great, but I don't like to consider gold as an investment. I look at that more as a hedge against inflation. Building a business is great, but I don't really look at that as an investment because this is going to require more time, more effort, more work. Lending is great, but you don't really see a proven return on the value of your investment. You'll get interest, but the principal value doesn't grow. You're just generating interest. So yeah, that is a great option. And banks have built huge businesses by lending their money out and generating interest. And investing in startups is also great, but it's more work, more time, more risk. And a lot of startups will fail. Again, this is great, especially for people that have more wealth. But if you're just starting off, this is much more speculative, more work, more risky. These two are kind of the more safe, proven, simpler ways to get started. Now, when it comes to investing your money in stocks and real estate, the thing that I want you to understand is there are also many ways that you can invest your money into these assets. You could go out and invest actively into the stock market or real estate, meaning you can look for individual stocks to purchase. You can look for rental properties to buy yourself. And these can give you some of the best tax breaks as well, because when you invest in real estate as a licensed attorney who's not your attorney, I can tell you that real estate investors get some of the biggest and best tax breaks that our tax code has to offer. But it takes more work, more time, more money, more effort, more headache, which is great for some people, not for everybody else. There are passive ways that you can get exposure to stocks and real estate as well. For example, in the stock market, if you don't want to do the research on individual stocks, which I think most people shouldn't, you can just invest in a fund that'll give you exposure to the broad stock market. For example, you can invest in the S&P 500. That's a group of the 500 largest companies in the stock market. Now, you don't have to do any work. You just invest in a fund that's giving you exposure to the S&P 500. For example, if you invested in SPY, SPY, this is an ETF that you can purchase on pretty much any brokerage. Now, I can't tell you what to invest in. I'm just a random guy on YouTube. I'm not a financial advisor. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But when you invest in this, you're getting exposure to the 500 largest companies in the stock market. So if Tesla were to go bankrupt, well, it will get kicked out of the S&P 500 and replaced by another stock, and you don't have to do anything. So this is a passive way to invest in stocks. There are passive ways to invest in real estate as well. There are funds on the internet that will give you exposure to real estate. You don't have to deal with tenants. You don't have to deal with the city. You don't have to deal with anything. You just invest your money and then let the developer of that property deal with the work, and then you get paid your distributions out of it. But you have to know how you want to invest your money. Find what's right for you. Don't just blindly follow a random person on YouTube. I'll tell you what I do, but I don't recommend what I do to anybody else. I invest my money in 5 places. Number 1 is my own business, Briefs Media. Number 2 is in real estate. Number 3 is in the stock market. Number 4 is what I call speculative. This is the startups that I invest in. This is the cryptocurrencies that I invest in. And number 5 is physical gold. This is from largest to smallest. Physical gold makes up about 2% of my portfolio, maybe even a little bit less now. Speculative makes up less than 20% of my portfolio. My largest investment is my business. And if we exclude that, below that is real estate. And when I invest in real estate, I'm investing for cash flow. When I'm investing in stocks, the bulk of my stock market investments are also for cash flow. So you have to know that goal. Is it appreciation? Is it cash flow? Then figure out how you're going to invest your money, whether it's into the government-sponsored retirement accounts. If yes, you can start with that. Then if it's going to be some of these private accounts that are not through the government accounts, great, but make sure what you're investing in can also meet your goal, whether it's growth or cash flow, and then you can learn how to do it. Again, I put together a free investing masterclass for those of you that want to learn more about how do you actually invest in stocks. You can watch the masterclass for free. I have the link for you down in the description. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.